New year, new video, new studio. But has our process changed? No. In fact, we're going to show you why there is so much more opportunity than the S&P. Sectors galore. Sit back, grab that cup of coffee. Let's get started. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, I am a practicing financial advisor. What you see here, the process I talk about, we implement to our portfolios and individual accounts. So you're sure to see some actionable ideas. So please, if you like what you see, hit that like button, subscribe, and we hope to see you again. Today, we're going to talk about the S&P. There's so much more. I talk about this. If you've watched me for a while, I'm not a buy and hold kind of guy. Let me tell you, now more than ever, things have changed. There are so many opportunities in sectors out there that you probably have never thought about. So today, we're going to go through the big charts. We're, of course, going to talk about our signals, positive in most cases. Number two, we're going to do that sector spotlight. We're going to show you all kinds of different stuff, opportunities out there. What keeps me up at night? Game plan going forward. So for now, let's go to the big charts. The first thing you should ask any advisor, what is your process? I've been working on this process for 6 years. It has grown. We have added things, taken a couple out, but where we are today, there's several factors that you will see. The one thing is the cycles, and I've mentioned this before. We were in cycle 3, we've gone to cycle 2, which is growth mode. A lot of people say, how can that happen? Well, GDP projected first quarter is looking to be the highest rate of change in 70 years. So there is your growth. It accelerates. Inflation accelerates. We're definitively seeing that. The Fed is hawkish, absolutely. And then we go from there. So when we talk about that, now see how that applies to our investment strategy. So I will start over here with my core charts, S&P, because that's what everyone talks about. This is what the big TV show, but there's so much more than that. But I do look at these for my signals. The first thing is, you see the monthly chart, there's your trend line. We broke above that, so that's bullish, okay? And the long-term trend line, and you can see down here, if I were to circle that, has had a momentum breakthrough. Not a surprise with what we have seen recently. So long-term view is definitely positive, right? So that means a bullish trend is still intact. Now, short-term, midterm, we're seeing some changes here. Now, the first thing is this is your weekly chart. So RSI, relative strength, when you're above 70, it's considered overbought. As you see here, we hit it and then it came down. So that's not particularly a great sign, right? Here's your breakout. That's definitely a good sign. And then we go down here and you see it just a little bit starting to turn over. So we're going to continue to watch that. As of today, we're still positive because we're definitely above that trend line. Momentum is still there. So positive long, midterm, we're also positive. Next up, let's focus on the S&P daily chart. Helps us make short-term decisions, right? Whether we're buying trends of the short-term market. The first thing is blue. Histogram is momentum, MACD. This is a rising channel, a rising wedge, which is very bullish. Now, a couple things. At the top end there, it actually failed. But then this morning, we hit the bottom end of the trend line, bounced off it. That's a good sign. So we're still in that rising channel, again, which is bullish. You look at momentum, though, you see here when we started going up, that's strong. That's a lot of momentum. Then we kept going, and it was, not a lot of momentum there. And then you see we're going the other direction, short term, okay? What else do we see on a short-term chart? Volatility. We actually hit 25 today, above 25. We'll talk about this in game plan. we got to be careful on what we're buying. Below 20, we are straight up bullish. 20 to 25 is a nice trading area. So volatility is still intact. Then you see relative strength. So why did we fail or pull back? Because we hit the high end of the channel. This is what the market does. Gravity hits the high end, comes back for a pause, and then hopefully what we're thinking about is it's going to go to the next level. Now, before I get to the sectors, want to make sure you're aware we're doing a webinar at the end of the month. Link below. Tax planning, 4 stages of retirement. Going to be a great webinar. Let's now go to Sector Spotlight. Sectors, lots of them. This is what we talked about in the opening, in our image of this video. So many opportunities out there that people aren't looking at. The S&P is all but flat this year, but we've got some really nice winners outside. Why? You get the dollar right, you get a lot of other things right. So, cycle 4, dollar goes up. Cycle 3, we see what's going on. And here, as we entered cycle 2, that's called a crashing US dollar. Couple reasons for that. 1, the Fed is dumping all this liquidity in. 2, the Fed, okay? So when you look at that, what does well at this time? This is the commodities index, CRB, right? Lumber, holy moly, just built this new space. Trust me, lumber's gone up. Corn, sugar, right? Any kind of, and of course, oil, right? So let's take a look here at oil. Look at the price of oil. Fantastic. Now, not surprising, above 70 RSI means it's overbought. Taking a little bit of a pause, that's okay. Another thing you follow when you buy crude is oil volatility. Just like we have the VIX for the S&P volatility index, we have the same thing for just oil. Remember back at beginning of last year when oil literally crashed to zero? We're talking about way up there in the 300s. We're down at 38 right now. Below 35 is where we'd like it. Not surprising we've come up because it's a little bit overbought, little stretch. Let's see what happens. Now, when you buy oil, for us, it's been oil, the price of oil, and oil companies, okay? So a couple things I want to show you here. 1, these are the oil companies. Understand I use indexes for compliance purposes, but we use ETFs for our individual investments. So the oil companies, you see where I got in, 11.9 and 11.20, 2 different positions. Yes, I would generally start a position, then add to it once I get confirmation on that trend. But as you go, you take profits, okay? Nobody has ever gone broke taking profits. So as you see, 1.6, I took my first profit, and yesterday, lucky me, took profits yesterday. Now, as of now, we're down about 4%. At one point, it was 5.5%, but that's okay. Take some profits. Let's see what happens. Maybe it gets oversold. We might buy back more. Let's see what happens, but this is part of the process, right? Buy low, sell high. Makes sense, right? All right, next up. The other thing we did with the dollar down are emerging markets, right? Not just the emerging market index. We've been a lot of different places. Take a look here. Indonesia, look at that. Love it, right? We bought here on 12.2. Actually forgot to put that. Took profits just yesterday as well. Japan, look at that. 10.19, 11.14. Now we had a full position. Full's about 5 to 6% for us. And we have taken profits on the 17th and again here on the 29th. We've had another leg, but with relative strength way above 70, it's going to be time for a pause. So when I take profits, I trim, I buy something else, okay? Something else that has some upside opportunity, okay? Here is China consumer. Here's another one. Forgot to put my dates on this one, but this has been a good move for us. You see again, you see what happens on every chart. When you get above 70 RSI, right, that's when you take profits. Take those profits because it bounces off. Bounces off. Now, sometime it can sustain, but I'd rather lock in that gain before moving forward, okay? Next up, am I confusing you yet? Hopefully not. banks. We talked about this on our last video a month ago. Took some time off for the holidays and to move offices, but I said I'm waiting for that right opportunity. Now, there's a couple things here that happen with banks. Not that I use this for my decision, but that's called a golden cross, where the 50-day moving average goes above the 200. That obviously looks good. So what happened with banks? Because guess what? Took profits yesterday, very fortunate. It got overbought, right? That's a great run, especially for banks, not the sexiest of sectors, right? It got overbought. We took some profits. And today, the bank sector as a whole is down, okay? So again, like banks going forward, I'd actually like to take a bigger position. Let's see where this short-term move takes us. Now, if you don't want to buy the individual countries like I have, because besides that, I've been in India, I bought Brazil recently. There's all kinds of opportunities out there today. You can also just buy the index. That arrow ends my last video, and you can see how far we've gone. The problem is it is way overbought right now. It's not a time to buy this. I'd wait for a little bit of a pullback, a little bit of a pause, because I think we're going to have another leg, because with dollar down, these countries do really well. So let's bring it all together and talk about our overall model. So right now, there's a couple things, all right? Core assets, 23%. So that's large cap growth, tech, okay, and marijuana. We talked about this the last video. Took a big position in that. That has been strong, okay, after the election. But that is one of my biggest holdings. Trimmed it twice, actually trimmed it again yesterday. Emerging markets, we've gone from 14 to 11, only because we took some profits. I'd like to be back in that 14, 15 space. Cycle 2 assets, so I've talked about those, but I talked about banks, which is a cycle 2 asset, but materials, consumer discretion, things like that, those are our assets there, 18%. Right now, I have 13% in individual stocks as part of our model. This is a 60-40 model, and I'm in all kinds of different sectors there. Compliance won't let me talk about that, but that's been a really nice alpha generator. Bonds, so 60-40 portfolio, you would say, okay, I'm 19% bonds and 16% cash. How in the world and why would you be carrying so much cash? Because treasuries, I'm in alternative bonds here, treasuries from their peak high are down like 15%, right? Because rates have gone up, prices have gone down, so I'd rather not be in those type of sectors right now. I am looking to deploy that in some areas, but cash is okay because this, and this all bought a lot of extra alpha return, so it's allowed us to really improve upon, I gotta think about what compliance will allow me to say. It has allowed us to bring extra value and alpha to our portfolios to bring above average returns over the S&P. Whew, that's a lot. All right, next up, what keeps me up at night? Okay, so back in December, in my video, I talked about being bullish. Everyone's like, what, Michael? Bullish? That makes me nervous, right? Yeah, and it's obviously has played out, especially with these cycle 2 assets. You know, you buy low and they've been able to grow. A lot of those assets I talk about, we got in at the right time. But make no mistake about this, folks. This is the most expensive market in history. So I'm still concerned. This shows you a couple things, right? The S&P is in black. S&P red is 20 PE, price earnings, right? Overvalued. 15 is fair value, meaning that's the long-term medium. 10 is undervalued. Now, a couple things. .com PE is 33. I will tell you if I go back further, 29 was 34. Right now, we're at a 38 PE. Hello, wholly overvalued, but right now you've got the Fed, the new government pumping money, we're seeing growth. I think this market is going to continue to go higher. That's how we're invested right now, but look at it this way, okay? If we were to go back to a 20 PE, see that? 1964 on the S&P, which is about a 48% loss. Not saying we're going there, but that shows you how grossly overvalued this market is. Unemployment, right? Yesterday we had another $1 million number, 965, 284 with the PUA. Those are self-employed. We've got 18 million plus people that are still unemployed. It's a problem. Yes, the market has gone up. It's created this big wealth divide. It is a huge problem. That leg of this, housing foreclosures, things like that, we haven't even begun to see yet. So that concerns me as well. And now with the new Fed, okay? Janet Yellen in there, Powell, right? Yellen did not cause, and this is Danielle Martina Booth, one of my favorites, did not call the housing bubble. In fact, she extended a credit line to IndyMac, right? She maintained for longer than most that housing would not produce collateral damage. Do you remember those times? I think she was a little bit wrong. Bloomberg said Jerome Powell could go down in history as the Federal Reserve's most transformational chairman since Paul Volcker. Danielle says, who was very close to Paul Volcker, said that before he died, he was very displeased with what he was doing. I could go on more. The bottom line is, this is a bunch of tweets from yesterday. Data dependent. Remember when the Fed said that they were data dependent? Ignore everything else about unemployment and inflation. Ultimately, the Fed seems positioned to continue what it's doing regardless of meeting its goal. In a way, it makes the Fed irrelevant to the real economy. The Fed is a big concern. So next up, game plan. What do we got here? Be patient, be smart, right? Take profits, lock in those gains, opportunities. There's so many. I just showed you, I literally have 50, 60 stocks. I've got 12 different ETF sectors that are on my radar. There's so much out there right now. Watch the VIX, right? Above 25, you got to be cautious. Below 20, we're off to the races. But 20 to 25 is a good trading zone. Follow us for updates, Facebook and all that kind of stuff. Links below. Thanks for watching. Michael Loftus, Wealth and Wisdom TV.